Greetings, Dr. Jeffrey Scott here. This is my weekend market update for April 14th, 2024, the day before taxes, or in many people's cases, extensions, are due. Thanks to those that join me today on the Wealth 365 Symposia. It's always a pleasure. Um, they always have a significant crowd, great crowd, great questions, great comments. Really appreciate y'all being there. And I appreciate those that have purchased my marketplace package. I do these, and I've been doing these for 20 years. I am independent, but I really appreciate how Rob Hoffman has incorporated what I do inside Wealth Charts and made it so easy, which is why you'll see how much I use it during the presentation. For those that are new to my channel, hit the subscribe, hit the alarm, and you'll get notified when I post these because I do this for fun, and therefore I may post them Friday night, I may post them Sunday at midnight, but this way you know when I've got it done. So my email address is hgsidoc@gmail.com, and I title this, Will an Oversold Bounce Save the Bulls? Not sure that's going to happen. There's a lot of data that says we do an oversold bounce, but this market feels like it's going lower, and even if we get a bounce, I wouldn't expect it to last a long time. But I'll show you objective evidence of what I'm looking at as we go. As always, this is for educational purposes only. I'm a doctor, not a broker. I'm independent. I pay for the tools that I use, and trading involves risk, and you are solely responsible for any investment decisions you make. For those of you that have purchased my Wealth Charts package, you should get an invite on the 24th, as I will be doing a masterclass from 7 to 10 p.m. If you have questions and you're going to be at the program or not, if you've already purchased the tools, just send me an email and I'll make sure I cover them during the presentation. For those that are new here, I also do something daily at stocksanddocs.com. Now, that's a bit of a fib. I don't think I've missed a weekend event in 20 years, but the daily depends on my travel. I always like to look at the markets. So the first thing is the major markets were down again this week. The NASDAQ was down 0.5%. The 100 was down 0.5%. The S&P 1.5%. The NYC 2.7%. The Dow 2.3%. And the Russell 2.8%. That's a pretty broad-based decline. Notice that much of this decline, in the case of the NASDAQ, all the decline, or enough decline to flip it from positive to negative, occurred on Friday, which was a very weak, and we'll see how telling it was, session. All the sectors in the S&P 500 were down on the week, and you could see materials down 3%, financials over 3%, real estate over 3%, and at least materials and financials had been holding up until this week. If we look at the Q Edge tool, we brought it out a lot because now we're looking at the S&P 1500, and what do I see? I see on Friday all the sectors were down, 99% of the industries were down, and 92% of the stocks were down. If you were up on a long account, and I'm not talking contra ETFs, you will be one of the world's best stock pickers, or you had one holding and you got lucky. It was a tough week, or a tough day especially, to make money to the long side. Notice how tall this bar is. This tells me that 19.9% of the stocks in the S&P 1500 are now trading below their Bollinger Bands. Now, if you think about the Bollinger Bands, the intent is they'll capture 90% of the activity inside the bands. Now, if 300 stocks in the S&P 1500 are below, they're going to revert to the mean. So that's where some of the thoughts about a potential bounce this week, but I don't think it's going to hold. Here you could see over the 5 days of the week, it kind of looked like Friday. All the sectors down, 95% of the industry groups down, 89% of the stocks. And if you go out 10 days, you can see it's been a week, 2 weeks in the U.S. stock market. Now this is another one of the Q tools. This is called market breadth. The USA Total View includes the NASDAQ and the NYSE. And what you could see here is we're rolled over after a series of Hindenburg omens, which is an ominous signal. There hasn't been a major correction that has not had these preceding it. And the bangos, which is the exuberance. And we've turned over, and you could see four of these indices, four, in fact, the top four on Friday gave us a big distribution signal. If we look at the NASDAQ composite and the NYSE, you could see that the NYSE actually gave us another Hindenburg omen. This here is a 13-week new high, new low on these indices, and you could see it's getting to a point, and you could see here the reversal points, where you might expect a reversal. Also notice that breadth deteriorated if you look at the yellow, which is stocks above the 50, and the white stocks above the 200 turned down on the week on both of these. This is the Nick Drendel report. This is like a $50 spreadsheet that uses public data, so there's no extra charge. And it's a great thing to have sitting on one of your desktop monitors. Why? It gives you a real-time performance of the market. You could see how bad the small caps performed on Friday. It shows you that they closed in the bottom quarter. It shows the relationship of the indices to their 8-day, 21, and 50. And the only indices above their 50 here are the Qs and the spider. Whoops. It shows me market breadth, how many stocks are above their X-day moving average. You can see very few stocks are above the 5 or their 20-day. If you look down here, you could see we had all-time, let's look at 52-week lows, 161 net lows versus highs on the NASDAQ, and even the NYSE is flipped to negative as well. When you look at one-day performance, I get a sense real time what's working and what's not working. Let's just say everything was negative. Home builders, I guess, was the best. And if you look at the 5-day change, everything was down, all the industry groups. And these are some of the major industry groups that I typically like to follow. I find this tool for the price to be a true bargain. Now let's look at the things I like to look at underneath that I think influence the market. In white, we have the 10-year rate. Over here, we have the 30-year rate. In yellow, we have the S&P 500. And what we have here is rates up, stocks down. Do we have a recession coming? We do, because we always do, but I don't think it's imminent. The concern is that we have a yield curve inversion. Here's the 10 minus 2, here's the 10 minus 3. The dark line is the zero line. The gray bands represent recessions. And if you look closely, you could see whenever we cross back above that line, we sort of predate an upcoming recession. Well, we're still below that line. Someday we'll cross back above and we'll undo this inversion. It's going to take higher long rates or lower short-term rates. And when will we get short-term rates? When the Fed starts cutting. And I don't think that's necessarily imminent, although the markets will often front-run the Fed. And perhaps the Fed cuts because the markets lead to a recession. But we'll see. We can look at things like credit tightness to get a sense. Are we going into recession? You could see recessions have tightness. No tightness. And we could look over here. This is the tightness over here. I put it in twice. All right. Well, I'm going to stop it. I'm going to fix it because I like, not that I'm a perfectionist, because I certainly just asked my wife I'm not, but because somebody might look at this later. All right, I just remembered I can't go back and repaste something there. I always forget that during my presentations. I will tell you that the Philadelphia Diffusion Index, which is what's missing, was also positive. So we have good economic activity. I don't see a recession in our near future. Now, stocks moved off the highs. The breadth got worse. You could see stocks above the 200 came down, stocks above the 40. And this is my favorite one, which is the T2121 and TC2000, which is a 13-week new high, new low. And you can see whenever it gets down a little further than where it's at, we bounce. And when we bounce, you can see the yellow, the S&P turns up. So I bet if we have a sell-off on Monday, we bounce on Tuesday or Wednesday, just because we're at a point where we're going to get an oversold bounce. An oversold bounce does not mean we're going back to new highs. Could just be a little bit of a bull fake and or a bull trap, and we go much lower. Um, oh man, I really did a bad job today. Let's see what happened to my buckets. Okay, so I think I know what I did here. This is the AD lines, and you can see that the big AD divergence is occurring between the NASDAQ composite, where here is the composite and here's the new high, new lows. On the NYSE, the NASDAQ 100, the Russell 1000, they match up pretty big. The Russell 2000, not so much, but this is the big divergence which is occurring on the NASDAQ composite. Now let me see if I can fix this one. Okay, well, I really messed up. This is what happens when I do this late at night. I apologize for that. Here's the buckets. 84% of the stocks in the S&P 1500 are below the midline of their Bollinger Bands, and I already talked about how many stocks are underneath. That is a very oversold condition. Now we know that oversold can become more oversold, but it also tells me that we're not that far away from a potential bounce. The Hindenburg-Omen signals are all over the place. They're all over the place on the NASDAQ. It showed up on the market breadth tool. It did not show up on EdgeRater. But both stock markets, the left and the right, the NASDAQ, the NYSE common, have Hindenburg-Omen signals that are active. Now, we've seen the sell-off come in. We'll have to see what happens. But notice what the NYSE just had no new lows for so long and had lots of new highs, and all of a sudden the new lows popped up and the new highs went away. The same thing on the NASDAQ. That's not a bullish thing. We got breadth issues. You don't rally when you're starting to lose new highs and gaining new lows. So I have my concerns about this short term in the market. Markets turned down. This tool takes last week's data, the fundamentals and ratings from last week. I'm looking at EPS rank, relative strength rank, and group rank, and then slice the market in deciles and ask where you fell in ERG, the combination of these threes, how did you respond? And this is an ugly chart. This shows me that the higher your ERG, the worse you did until the end. And these are some stocks that there are very few stocks bound here, but I suspect Meta is probably one of the drivers at Amazon on the high ERG. EPS rank was down across the board. Relative strength rank, really, it's hard to say that the higher relative strength stocks did any better. They did better than the zeros, but they didn't do better than the rest. So this was not a great week for growth. Now, what's coming up this coming week? We've got 2:30 in the morning on Monday at Fed Head. We've got retail sales. We got another Fed Head at 8:30. So you got two of them before the market and Mary Daly after the market to spook the market. We're also going to have reactions to what's going on with Iran and Israel as I'm talking. On Tuesday, we got some housing numbers. We've got a Fed Vice Chair Philip Jefferson speaking. We got production, and then we got Powell speaking on Tuesday afternoon. Wednesday, we got a beige book, and we got two more Fed heads. And Thursday, we got some jobless claims and more Fed heads. When that many Fed heads are speaking, the likelihood of volatility, in my opinion, goes up. Now, they may not like what they saw in the market this week, and they may want to talk the market up. All they got to say is, we remain data dependent, and we have not taken rate cuts off the table or changed our forecast. Do you think they're going to say that? They might, but I doubt it. They might also say, I'm not sure we need rate cuts, in which case the market's going to go down. If we look over on the right-hand side, you can see we're starting the second big week of earnings, and there's a lot of big names here, some that you might have. Bank of America and Goldman might try and save what we saw in financials on Friday. You've got some small banks there. You've got some tech names. You'll see Netflix. As I say in the lower right-hand corner, and that actually is my comment. It's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. So for those who are new to my channel, I have one more slide and then I go into wealth charts. And what that slide says is that the stock market closed with solid losses this week. Market participants had a lot to digest on busy week in terms of market moving events. The downward bias was driven by rates, recalibration of rate cut expectations, and increased geopolitical tensions. As I mentioned, late night on Saturday, Iran carried out retaliatory attacks. Doesn't sound thus far that there was a lot of damage, but that can't be good for the markets. The eagerly awaited CPI and PPI were mixed. CPI hot, PPI a little bit cool, but any bullish sentiment that may have come out of that cooler PPI, which led to a rise in the market, I believe on Thursday, could not be held on Friday. I think Fed speak's going to walk back on the number of cuts, and we might even hear about the next move potentially being a raise. Could you imagine what that would do to the market? My market signal significantly weakened this week. If we have any follow through to the downside Monday, I will consider expanding my contra ETF portfolio. I've raised cash, no margin, staying small if I go long with tight stops. I do expect a bounce this week, but markets can get much more oversold before they bounce. So now I'm going to go in and let's look at some charts. Let's look at my timing model. Again, thanks for being here. Remember, click the subscribe and the alarm so you know about when I post these in the future. If you like this, please hit the like, the up thumb, and I respond to comments, whether by email to hgsidoc@gmail.com or in the YouTube comment box. Now, my weekly timing model for those who participate in today's Wealth 365 event, it's a simple model. It's a weekly chart, price above the WMA 30 period, and a green bongo. I need both of those to flip to a long. To flip to a short, I need price below that line, and I need the bongo to be red. So I have a nice long signal still on the spider, and I'm still technically long on the others, but I have to pay attention and notice that the Russell is right above the WMA. The diamond is sitting on the WMA, and their bongos have already flipped to red. So we are very close to going to a straight sell signal. So right now, this is a weak market. It's not a market that I really think I have a lot of new longs to show you about this evening. Now, last week we were talking during the week about the daily model, and you could see where the enter short arrows are. The daily model went to a sell signal across the board on the major ETFs that I watch. And again, the 30 period WMA, now it's a daily, and the bongo now that it's a daily as well. So they're all technically in sell signal. So how do I put that together? In any long-term market move, the first thing that's going to roll over are the daily charts, and then the weekly charts are going to hold on. And then the weekly charts are going to roll over, and I'm going to go into sell mode. The daily charts have a tendency of whipsawing. So my main direction of the market still on the long term is still up. My conviction is really gone. I have very little conviction to the upside. And in fact, I've lightened up, and I think we're going to go down significantly here. Look at how much of a move. What would a 50% retracement since October lows look like? So we could add an indicator. Let's see if I can find the fibs here. I don't usually do a lot of fib work in this program, and now I got to figure out where it's at. Oh, I know where it's at. My bad. It's not an indicator. It's in the drawing tools. We haven't even hit the 23.6% retracement. We could still drop significantly from here, at least another 10 points to get down to the first. Or do we drop 30 points? So I think we still got pullback to go, but it wouldn't shock me to see us do one of these. Let me get to freehand, which is the markets to trade up to that WMA and then fall. We don't usually go straight up. We don't usually go straight down. Okay, so that's the timing model. let's look at the indices and let's look at the spider on a 5-minute candle, 5-minute chart. So you could see, and now it's time for me to add Friday here. I keep this up because I look at this every day. It just gives me a sense of what on a given day the market did. And I like to look at the week we just came from. So Monday, the close on the prior week is somewhere in this area right here. Right here. So you could see we spent Monday just above that. We dropped hard on Tuesday, tried to recover at the end, gapped down on Wednesday, which was CPI day, traded higher on Thursday because of PPI, and then Friday we just gapped down at the open and just continued to trade lower. Perhaps it was financial earnings. It was a tough day in the market. If I look at the daily charts across the big market indices, you can see the S&P today, or excuse me, Friday was down 1.38%, just above the 50-day. The Qs were down 1.52, just above the 50, which has been my first target. The diamonds didn't listen to me, and they broke down 1.2%, have totally broken through that 50. And the Russell has broken through the 50, was down 1.78 on Friday. Really a rough day in the market. Now the VIX took out a descending trend line, a trend line that goes back a while. I could have added more. That's probably meaningful. It was up 8%, and we'll see if any VIX instruments look interesting from a long perspective. What's not great for the bulls, the dollar had a strong session again, and now has taken out that 200-day and is now up here challenging what had been resistance at points in the past. Not good for the market to see the dollar moving up. On the commodities front, the strong dollar, we had a big reversal in gold. What a great run gold had. Is it done? I think it might be. I think it might be for a short period of time. I still have El Dorado gold that I'll have to decide what to do with. But what a beautiful run. But gold, that's a reversal candle. Silver, bearish engulfing, reversal candle. Oil had a flag, looked like it was going to break out with a gap up with what's going on with Iran. Who knows? Oil may be up. But oil netted out kind of flat on Friday. And then the other thing that's concerning it beyond the dollar is the 10-year is starting to go back higher. It's taking out a line here that had been resistance multiple times in the past. So I think there's a lot to be concerned here, folks. The volatility is going up, the 10-year is going up, the dollar's going up, and the markets are going down. Doesn't mean it's a 20% correction, but it certainly feels like that's where we're going. Now, the sectors really rolled over. Look at financials. This was one of the leading sectors a week ago, and on Friday it just tanked. So where is the strength? Who gets my star? I could say nobody. Materials, which was leading, had a rough Friday. And these are ratio charts comparing the S&P sectors to the spiders. And I look to see from a relative strength perspective which one's really outperforming. Maybe staples turned up a little bit because of defensive play. Utilities have started moving up, not my favorite place to invest. Interestingly, technology popped up a little bit. But if you look at what's really leading this market, it's probably industrials, energy, and still materials based upon the height of their chart. But boy, nothing really strikes me as being good. If I look at the scanners, and let's start with the heat map. And the heat map looks kind of red to me, doesn't it? I mean, Apple was up. Somebody I heard listening to said it saved the day. Well, the day still sucked, but Apple at least had an EMS signal. Volume came in. Relative strength and OBV looked good. Is this the beginning of the recovery from Apple? It failed at the 50. We'll see if it can get above that. I think Apple could pull the market up in the short term. I still think this market's going lower. If I look at Wealth Scanner, I fell out of my chair when I saw this the first time. what had lots of 800s with a lot of gold, silver, copper, um, miners, energy. Nothing is above 800. This market reset itself this past week and really weakened. The dollar is the leading ETF. Well, if the dollar is leading your market, this is a tough market. If we look from a bearish perspective, give it a second to run, and we see what's leading to the downside: biotech, pharma, bonds, corporate bonds, clean tech, high yield bonds, real estate, interest sensitive, real estate, real estate. There's a lot of weakness in this market, and some of these were holding up. And look at ARKK, Kathy Wood. Probably come back and test the 200. We see if it bounces from there. So this market has weakened. And if you look for anything that comes out and says, buy me, buy me, buy me up here, dollar, short the bonds. We talked about that early in the week. It actually lost a little bit on Friday. Here's silver miners, but this was 800. This was a pretty big reversal, so I have to see what happens at this point. Uranium has looked good. Last week we talked about CCJ, which is one of the leading uranium stocks, had a nice move up. Here's a flag, a breakout. It's not over. I think this one could certainly go higher. Energy is now down in the 400s. Market really reset this week. Now, my favorite tool, no surprise, is my CAT scanner. And if I look at all symbols in the market and I look to see those that have bullish patterns or bullish pullback in an uptrend, Copang, Qpeng must have had some new, earnings this week as my guess. And I guess we could figure that out real quick. Well, I'm not going to look right now. That looks like earnings or news, big volume. It says extended by high jump, but this is when I see that fourth dot, I will chase. That's a Morales and Catcher type Bible gap up. So if you really want to be long, that's not a bad looking chart. Theravance Biopharma, you can't like anything that shoots up and comes right back down. That's a shooting star typically. Failing at the 200, that's not going to maintain. Now look what's up. UVXY, volatility. Volatility. That's not good for your longs, folks. Massive volume, breakout momentum, out of a squeeze, not extended, relative strength and OBV are high. That scares me. VIXM, midterm futures, volatility. Massive volume, breakup momentum, coming out of a squeeze, relative strength and OBV look good. What else? VIXC, short-term volatility. Do you see a theme here? The strength in this market is volatility, not good for the longs. Volume, breakout momentum, out of a squeeze. And then VXX, which is a 2X ETN of volatility. And look at this, massive volume, breakout momentum. I don't think this trade is over, but be careful with these. If and when the market rallies, they'll get crushed. Now that said, they're pretty cheap and they've been going sideways waiting for this to happen. But when volatility is leading, we're in bad shape. PSQ, shorting the Q. This goes up when the Q goes down. Breakout momentum, relative strength and OBV look good. RWM, this goes up when the Russell goes down. A breakout above the 50. Wow, these are buyable looking things. TWM is another Russell short. TZA is a 3X short Russell. Look at that, a breakout above the 50. Decent volume, breakout momentum, relative strength and OBV look good. DXD goes up when the Dow goes down. This thing's broken out and running. Another one is SDOW. So to the long side, no dice. No dice. Be very careful buying stocks, traditional stocks to the downside. Excuse me, to the upside here. If you want to buy something to the upside, consider those contra ETFs, some of which we just ran through. They actually go higher when the markets drop. Now, I do have other scans, and I just very quickly want to look at retracements and downtrends and look at the number of stocks that make it here. Some of them are going to look interesting. APLS broke down below the 50. Um, Big volume, breakout momentum. Look at relative strength and OBV rolling over. I'd rather see it retrace up to the 50 before I was shorting it. Blackstone kind of just popped through, squirted through the bottom of this support. Does this run to the 200? Here's volume, breakdown, and momentum. Look at relative strength and OV. Microchip, a lot of technology stocks look like they're rolling over. This is one, but I think NXPI is the poster child. Here's a stock that's been in a great uptrend, has respected the 50, and it closed below the 50 on big volume, breakup momentum, out of a squeeze. Look at relative strength and OBV breaking down. TQQQ, well, of course, we saw PSQ, so here's TQQ dropping below the 50. And you could see volume, breakdown, momentum to the downside out of a squeeze with relative strength and OBV weak. There are a lot more stocks that are potentially shortable than are buyable. I did create a watch list that did have some buy stocks. Why? Because I probably lean that way most of the time. And let me see if there was anything. And in fact, that is last week's buy list. So import from CSV. This is going to be the buy watch list. Excuse me. Choose file. That's how you import a file. Those are all in CSV files. And while I'm at it, you know what? I think, yeah, I forgot to do something. So I'm going to take clear list. Yes, I'm sure. And now import from CSV. I'm going to find my buy watch, choose the file, buy watch. And these were the ones that I looked at, and it's not a big list. While I'm doing that, let me pull my shorting list in. It was a bigger list. And these are stocks, not that I'm going to short on Monday, but they're sort of a shopping list of things that have broken down that I'm going to look for retracements and then buy them when they break down again. So NXPI, for example, is there. CLAC is another tech play. Breakdown below the 50 could be interesting. Thermo Fisher broke down below the 50, squirted down there. This one looks interesting, moving down perhaps to the 200. Look at relative strength and OBV weak. And then on the buy side, there really wasn't a lot for me to like. In fact, it's going to be real hard to show you. FTAI has been a big mover. It hasn't broken down. It gave you a little bit of pullback here, a bit of a triangle. It's no longer extended. This might be something if the market turns up. Datadog is one that broke out on Thursday and held the 50 on Friday. So it was up 3.96 on Thursday, down 2.5 on Friday. Again, if this market holds up, that might be one that looks interesting. ETN has just been a great story, continues up, pull back to the 17. If the market goes up, FTAI, great move. I may have shown you that already. It's tired. FIP is an infrastructure play. A little bit of a flag and a breakout on Friday. It's a cheap stock, might be one that's worth watching. And then I got some hopiums. Hopium, Costco. Costco's sitting right on the 50. All great stocks will pull back to free parking, which is the 50-day, and it's a great place to move from. Let's see if it can get some momentum off the 50 if we bounce on Friday. And another one that's done the same, let's see, Melly, which is a great stock and a great company, has pulled back to the 200. In the past, when it's pulled back in this area, and this is going back here to 23 January, it's been a tasty time to start to buy. No signal to buy there. In fact, I'd be more likely to short this candle, although it's right on the 200. But those are worth looking at. Uh, on cloud has pulled into the 50, couple of bottoming tails here, but it hasn't broken out or moved yet. These are a watch list. And there's your CCJ. So, sorry for some of the mix up on the slides. I wanted to get this done tonight because I told people on the Wealth Charts program that I would be doing it. If you're new, welcome. I hope you got something out of this. And to me, careful time. You could be in cash and feel pretty good if the market goes either way. If you don't know what to do, sometimes I'll sell half of my position. If the market plummets and the position goes lower, I feel good because I took profits. And if the market goes up, I feel good because I kept some of my position. Trade safe. You don't have to trade often. Sometimes there's a good day to just sit on your hands. And right now, I want to see what the market does on Monday before I make any commitment because I do expect a bounce, but then I think we're going lower. Have an awesome week, and I'll be on Stocks and Docs on Tuesday.